It should pop on it. Oh, there we go. What's happening there, Veta VA? Christopher Griffith here with Helmer again that's not right.
I wasn't going to correct you. You know, I had a football coach in high school that called me
good.
Helmer for like my whole career. It was almost like a sitcom. Yeah. No, it's I just go by Helmer. Helmer. You just got to switch your.
It feels like there should be more letters in there. I'm just going to call him Hammer. So Christopher Griffith and Hammer here to talk to y'all kind of about what's going on with interest rates this week. Some of the numbers and things that we've seen from the last couple of weeks and how they may impact the future of what's going on. The goal is never to make you think a certain thing, but always to help you to understand the variables and the things that can happen that determine those so that you can make a better educated choice yourself. But a lot going on. Like it's been kind of a crazy couple of weeks right there.
Yeah.
Hammer?
Oh, yeah. Yeah, absolutely. And unexpectedly so when you look at some of the events. So I think we should kind of just give a high level overview of what's going on with rates and where rates are probably headed. And then we can dig deeper for those of you that want to learn a little bit more about why, and then maybe figure out what's going to come next or why we think what's going to come next. And you guys can form your own opinion. How's that sound?
Yeah. That sounds like a great. We'd like to start off, as always, by saying the quickest and fastest way for you to save a ton of money on your mortgage is shopping. For the love of God, guys, please shop your mortgages. The fastest and best thing for you to do to understand what's out there, how people do things differently, because everyone does things slightly differently. And what those options achieve for you is by shopping. We think that is a good thing to encourage you toward. And we want to put it up front and foremost for you to hear each and every time that we talk about interest rates. Don't be afraid of them. Don't be like, oh my God, they're going up. It's going to be okay, guys. Hammer?
Yeah, no, I agree. I agree with that huge. And one thing about shopping for rates, if you're going to shop rates, there's only, I guess we could probably come up with a few rules, but one really important rule is you need to do it at the same time, because rates do move based on how the markets move. And that's what we're going to talk about today is what's the underlying factors that are moving interest rates and what direction are they headed. But also make sure you do remember that, because if you had gotten an interest rate quote last Monday, and then you call today and you call somebody new and you get an interest rate quote and you say, wow, well, these are very different. I'm going to go with the better rate. We've seen a big rate movement between last Monday and this Monday. And that was because of some of the things that are going on in the back end. And I'm going to share my screen and we'll show them some of that stuff. So let me click the share screen button. There we are. And which screen we're sharing. There we go. All right. Oh, it's funny. It must be something on my computer. Christopher, does that look normal to you or does it look like red and yellow?
There's a bunch of orange and yellow in the background, which is kind of odd. I mean, I like yellow, so it's not particularly difficult for me to look at, but I still see the screen you're sharing, I think.
I'm not panicking on it yet though, because it happened to me this morning and everybody said they saw it normal. I think it might be something on my end. I don't know. I'll restart my computer. So anyway,
we just had a lot of people drop off. So I might say you may change the colors. Yellow and orange doesn't seem their cup of tea.
Yeah, no, I think that most people are seeing it normal. So let's go ahead and kind of do a quick recap of what happened last week. I want to show you guys some goofy charts while we do that. And these are Japanese candlesticks. And what these really mean is that each day we're watching what's happening in mortgage bonds. Mortgage bonds are the underlying factor with mortgage rates. So Christopher and I have talked about it before that lenders will all have their own margin and their own expenses. So basically, it's kind of like if you were making a sandwich, this is the bread that everybody is making their sandwich on. And then they're all going to put on their own meat and cheese, and that's going to adjust the size of their sandwich. But at the end of the day, one thing that's always going to change is that bread. But everybody's starting with the same bread, if you will. So when we look at these Japanese candlesticks, we're looking at a few things in particular here. When we see red, it means mortgage rates are generally getting a little bit worse, or your credit, your rebate pricing that you may get, that sometimes the lender is able to give you a credit when you have a particular rate. And we call that a rebate pricing. And that's getting a little bit worse. So if you were getting a loan and for a few $100,000 and your interest rate was say 3.75, you might've been getting $500 or $1,000 in credit towards your closing costs. And then now that 3.75 might cost you $500 or $1,000. So we've seen that move from one direction to the other. The reason that this happened, let's go through this. I'm going to explain to you what's on this chart we're looking at and kind of what happened last week is on Thursday. was this smaller red candlestick here, and on Friday was this larger one. The beginning of the week was pretty quiet. It was just a normal week. Rates weren't really moving. They were consistent one day to the next, not really much of a change. But on Thursday, something happened in Europe, and that was the European Central Bank. They finally admitted that inflation is an issue in Europe. And it's been an issue, but just like our own Fed here, they called it transitory. And, now we're coming up on almost a year of inflation, and it was transitory. And they were said, oh, it's due to supply chain issues, as we can't get things here fast enough. But as this goes away, inflation will come back down, and inflation didn't come back down. And the Fed has now realized that they need to take steps to control inflation. And we're going to talk about that. But that's one of the reasons your mortgage rates are going up is inflation. And the European Central Bank has now admitted as of last week that they also have an inflation issue. And the European Central Bank president, Christine Lagarde, she even though she tried to be very even keeled, she admitted that the European Central Bank is likely to have to follow suit with what our own Fed is doing. And that is to raise policy rates. Now, the Fed does not control mortgage rates or student loan rates or car loan rates. What the Fed controls is a particular rate called the Fed funds rate. And we could really get into the deep economics of it, but it's kind of a funny thing because this rate is the rate that banks borrow money from each other in overnight lending in order to meet reserve requirements. And it seems like it's just this little rate that should be off to the side, minding its own business. And instead, this is like the granddaddy rate. And as the Fed controls this rate, it ripples through the economy. And as they manipulate this rate and they set this rate and they can raise the rate or they can lower the rate, they basically are trying to speed up the economy or slow down the economy. And right now, we're trying to slow down the economy because in a couple of years ago, when COVID hit America and everything came to a screeching halt, the economy was tanking. And the Fed needed to make sure that we kept the economy moving. So they basically went, they threw out all the anchors and they just got rid of everything. And they just threw everything in, including the kitchen sink at this thing. And they dropped rates, their Fed funds rate down to zero. And mortgage rates also dropped. And the economy started to work its way out of COVID. And then as we've come out of what I call our COVID coma, where people are no longer staying home. They're going out spending and they're going out vacationing and they're going out traveling. And the economy has heated up tremendously. In fact, most of the economy is actually doing better than it was before the pandemic. But what happens is when the economy gets too hot, it starts to overheat. And that's where we now see inflation. Because as you have all of this consumer spending, you have increased demand. And if Christopher and I both want that same lamp made out of that leg for Christmas. You know that lamp, right, Christopher? The one with the little fishnet stocking lamp that they had on right? If we both want that lamp, well, maybe we're outbidding each other, or maybe Christopher buys the last one and, now there's an appetite for more of them because I want one and I've got some money in my pocket, especially because the government gave me some, and the government did do a lot of stimulus this time around to keep the economy moving. So now the economy is overheating, and the Fed has what they call a dual mandate. The Fed has two jobs that they have to do. They have to keep employment maximized. So they're going for maximum employment. And they also need to keep inflation at or around 2%. So we've had, I don't know, how long has it been since we've had inflation, Christopher? I want to say it's been over a decade.
It's in any, I think, meaningful, measurable way outside of, anything significant. I think you're right. I don't recall it being even a part of the conversation.
It's been a long time. And now we went from famine to feast. Now we have 7% inflation, and there's a couple different gauges and a couple different ways of measuring it. But no matter how you measure it, we have a lot of inflation. So there's been strong demand, and now there's large inflation. And the Fed needs to get that 7% down to around 2%. And that's really what's going on. And the European Central Bank, to kind of bring back to my loop what I was talking about 5 minutes ago, the European Central Bank is realizing that they have to do the same thing, that the economy in Europe is also now heating. Europe is backing away from a lot of the mandates. They are opening up their borders. People are out spending money. the economies are heating up, and now it's time to see interest rates rise. And this is a natural path for us all to see interest rates rise. And it's something that when you're buying a house can be pretty scary, because there's a lot of emotion tied to your interest rate. And can I afford this? And it's, we get told it's the largest purchase of your life, and it's hundreds of thousands of dollars. But don't be scared by these interest rate increases, because you're still going to be getting an asset that is definitely appreciating. Would you agree, Christopher, that we're not in a housing bubble, and that
I think to argue a housing bubble, I think is, I don't want to say foolish, because there are probably a lot smarter people than I am claiming that they think that there is one. I think that there are things in markets that could ultimately have valuation difficulties, and those things, as most things in real estate, are determined by, for the most part, supply and demand. And that's the greatest curve they have to show going away, which is the need for new housing starts, coupled with transition housing from different places, is going to lower overall volume of transactions. And I think that would be a difficult thing to show in a significant way. I do think that cooling, it would be a good thing for the record. I think that it would be good to have some cooling to it, because demand is outpacing growth in wages in a lot of places, not all places, and wages are actually growing significantly, I think, in a lot of sectors. But to say that we're in a housing bubble, I think is incredibly short-sighted. I think that it completely disrespects the nature of real estate valuation, and why even during 2007 and 2008, there were emerging real estate markets that were growing and booming even during those periods. So for all of you out there that are watching and you're scared of a housing bubble, don't be scared, first of all, because as soon as you're scared, you lose. Second of all, look for people that are using data to support their opinions and their statements. I know a few of them, which we post on these. We're going to be having a housing specific economist in later this month, probably, to discuss that some to a degree also. But no, I don't think that we're in a housing bubble. I think that the overall debt that sustains the housing new starts or purchases or refinances are a lot better founded. I think that consumers are carrying personal debt as well, but not to a degree that's incredibly difficult. And even though their reserves are waning a little bit, they're still significant, as well as their equity position. So unless banks start taking equity and not offering modification or willing and wanting to have in those circumstances, I don't know. I don't see it. Man, I'm not a smart guy, but I don't see it.
Well, and it's not. And in fact, one of the things, because we have such a low inventory of houses for sale right now, it feels like there are no houses selling. And it's actually the opposite. There are more houses selling. More houses were sold in 2021 than we've seen since 2006. There were more transactions, more actual houses sold. The inventory remains low, because as fast as they're going on, they're coming back off, because the demand remains high. And even though we see mortgage rates that are creeping up, and, again, I'm not quoting any particular rate. This is not a rate quote. But generally, you're going to see rates that are in the higher threes right now, maybe in the low fours, depending on credit scores and what the purchase is for and what kind of loan you're getting. But these are interest rates that are about a point higher. They're about 1% higher than we had, in, I want to say, a year ago, when the height of the COVID pandemic, when houses were just they were still moving like hotcakes, and rates were very low, and it was driving the sales prices up. So hopefully sales prices do calm down a little bit, and they shouldn't go up as unnaturally quick as they are, for sure. And interest rates will go up, and that'll bring that down. But I don't think you see many markets where rates are actually going to go backwards. I'm sorry, where home prices are going to actually go backwards. I don't think that we're going to see a scenario that if you bought a house now, that you're going to regret buying that house a year from now thinking, man, I lost a little bit of equity. I just don't see it. The demand is still too high.
Here's what you need to look for. If you're trying to figure out if you're in one of those places that we don't see happening in mass events, look for major losses of population, major losses of employers. These things lead the things that substantiate the money in a market needed to create the value in the real estate itself. So when you have massive chunks of population, jobs, and those types of inputs leaving the market, you may consider the state of the market, the amount of volume available, the other demand of people moving there from maybe different type of circumstance. But those are the things that I think you should really pay attention to if you're concerned the market you may be in could be a market like that.
Yeah, absolutely. The very well put, very well, nice, clear ways to see that. So let's talk interest rates a little bit. Interest rates did go up a little bit last week. I was mentioning that part of that was the European Central Bank taking some steps to slow down the economy. Why does that affect the U.S. economy? It's because we're in a global economy. So there are overseas countries, well, all the countries overseas are overseas, but there are overseas investors that do buy our bonds, and that all kind of does have a role. But the more significant move that we saw last week was on Friday, and that was with the labor data. So we get what we call non-farm payroll, which is basically how many new jobs have been created. And expectations were that the current bout of COVID, the current variant with Omicron, it's a very wide spreading variant, and it was hitting very quickly. There was expectations that there was only going to be about 125,000 new jobs created in January. And instead there were over 400,000. But the real kicker, the real thing that made a big difference was the revisions. So over the last 2 months, they said, well, whatever it was we said, add 700,000 to that. They added 700,000 jobs that maybe they missed the first time around to those last couple of months. So we have just a labor market that is growing by leaps and bounds. And what happens, that Fed has a dual mandate. They need to keep maximum employment, and they need to keep the inflation at or around 2%. So everybody's been looking for the Fed to start taking action soon to raise that Fed funds rate. And originally, towards the end of last year, September, October, people said, we think this is going to happen in June of 2022. We think the Fed will start raising that interest rate. And generally, the Fed raises the rates in steps. They take small increments. They're a quarter point, or what we call 25 basis points. So it's a quarter point movement. And again, if you were looking August, September of last year, you figured the first one was going to happen in June. It might be a quarter point, and the Fed was expected to do that 2, maybe 3 times in 2022 because they just needed to slow the economy down. Well, the economy is just raring. It's fuel on the fire. This thing's burning crazy, and employment is skyrocketing. So the Fed doesn't have to worry about affecting employment if they start to slow the economy down because employment's so strong. So this basically opened the door to where the Fed now is expected to start raising rates in March. The next Fed meeting is about 5 weeks away. There's no meeting this month in February. There was one in January, and the next one is in March. And everybody was expecting in January, as rates started to go up, that was because everybody was expecting the Fed was going to raise rates in March. So they said, okay, well, not June. Now we think it could happen earlier, maybe May, or even in March. Those are the next meetings. So we've seen rates start to creep up. Mortgage rates are creeping up. Well, now there's an expectation that not only can the Fed raise rates in March, but instead of doing it for 0.25%, they're going to go in with shock and awe. And this is something that they have actually, I don't want to say they've never done. The last time the Fed raised rates by 0.5 point was back in the early 2000s. I think it was 2002. And they did it mid-cycle, meaning they raised rates by 0.25%, and then they did 0.5%. So they kind of built up to it. The expectations now at the market is they think there's a 30% probability that the Fed is going to raise rates by 0.5% right off the bat. They're going to swing big and swing hard. They're going to come in March looking to slow things down because they've got to get inflation in check. I spent $4.69 on a loaf of bread yesterday, Christopher. $4.69.
Is that a lot?
You know what? No. I didn't. It is because I don't buy bread that often, right? My wife
I don't either.
usually picks
I like tortillas.
So I'll tell you what, a loaf of bread was usually around half that, like $2.50. Last time I remember getting bread.
What type of bread? Like off-brand bread, name brand bread?
This was Arnold whole wheat bread, not the 12 grain stuff. Too many seeds. But the whole wheat, the stuff they tell you is good for you, which is probably not good for you anyway. But yeah, $4.69. Even the cheap bread, like Wonder Bread, was always a cheap bread. You could get a loaf of Wonder Bread for 99 cents. That was $2.69. So my point is inflation is driving the prices of food, energy, and all of our other goods up. And, we need to get that under control. So that's what the Fed is now expected to take some really big moves to do that. And they're going to do that in about 5 weeks. And let's see, if I throw that screen back up here, I'll show you guys something cool I like to follow. This is a chart about what they call Fed futures. So the idea here is that in March, at March 16th, when the Fed comes out with their next announcement, that we are 70% probable, so, almost 3/4, to have a 25 basis point or a 1/4% interest rate hike. But there's almost a 30% chance that we're going to see a 50 basis point, so a half a point hike. Now, again, I told you that was a new phenomenon. If this is a comparison chart, and I'm going to show you what all these silly little colors mean here, is that the lighter the color, the longer ago it was. The lightest blue is a month, then it goes to a week, a day, and the current probability. So this light graph that you see here, there were even some people, there was almost 25% probability just a month ago that the Fed wouldn't raise rates at all in March. That was the belief a month ago, that the Fed may not even raise rates. Now, the highest probability is that the Fed will raise rates by a 1/4 point, but there's about a 30% probability the Fed may come in strong, like we've talked about, and come in with that half a point rate increase. And if we see this belief increase, we see more investors that start to buy into this, what's going to happen is that's going to affect the markets, and that's going to push mortgage rates up earlier. So we don't wait until March when it happens to see mortgage rates rise. Mortgage rates actually creep up now in anticipation of these Fed rate hikes. And that's why you're seeing mortgage rates last week that got a little bit worse or a little bit higher. So if you had been quoted a rate on Monday, and then you were to check that rate again today, you're going to see a difference in those interest rates. And it's not necessarily true shopping. You want to make sure you're shopping on the same day, because you would see a difference in the market based on what happened last week, pushing interest rates up. Anything you want to add on that, Christopher?
I have a bunch of questions. Like, I'm just a participant in these like everyone else, but I'm wondering how much of this could be circular or difficult. Let's say taking the whole how do you boil a frog kind of a thing. If the Fed doesn't react enough and demand doesn't change whatsoever, and the base costs increase everywhere because of their actions, then you could have like this long growing difficulty where you could almost argue inflation was made worse, right? So it's like, in my mind, I think, don't they have to act significantly enough to cause a bit of a slowdown? Isn't that somewhat true? Because if demand doesn't slow whatsoever and costs continue, it seems to not accomplish what they're trying to.
Right. And inflation is ultimately bad for mortgage rates. So it has to do with the way that mortgages are sold. We've talked about it in the past, and we'll talk about it again, but it has to do with the bond market. And
sure, it impacts their servicing value, the value of the people that substantiate that debt. Everyone thinks money's just, when money's printed, it's not like it's just printed on a piece of paper and it exists. It's created with debt. Debt creates money. It's literally, I don't know how you would disprove that. So inflation eating away at the yields on those will only drive the cost of them up further, right? Because just like in a rental house or any other thing, investors have to make a margin on their capital or their risk and investment in order to participate.
Very much so. And so we've got, pushing back on inflation is what they're looking to do now. What was your other question?
If they don't act hard enough, is it actually a problem? Or if their first reaction isn't significant enough, could that be a more difficult problem if demand continues to remain exceptionally strong, as it has?
Yeah, and that's what a lot of people, like you said, that I'll borrow your line. A lot of people smarter than me are asking that. Is the Fed acting strong enough, or have they already waited too long? Should they have acted sooner? And that's one of the things that it's almost it almost creates itself, because a self-fulfilling prophecy, if you will, because a lot of investors, they're questioning it, they're waiting to see. And then when the Fed does act, are they going to buy into that? Or is it something that's, our stock's going to drop, or is it going to slow consumers down from spending? And that's a great question that we'll have to wait and see. And it takes a couple months for it all to really kind of take its full effect.
Yeah, but inflation's like this big bully, and there's only one way to, you can't softly, right? Are they going to punch the bully in the mouth or not? I think is the kind of curiosity. Mine as well. I think that inflation is something that it's hard to argue against its in existence, especially now with everyone making their cases nationally and internationally, rather. It's going to be exciting. I think that there's a ton of opportunity. If you're hearing this discussion on inflation, like, if inflation's a tidal wave, the best way to kind of ride that out in a very big boat,
Yeah.
big asset. You need a big asset because then you have a better chance of not going underneath and being completely overtaken by it, right? And so that's the point that's significant to many of y'all out there. If you're concerned about inflation, you're concerned about rates rising, you're concerned about housing for your family because that's a must and a need. And as a vet it was after we were active duty, almost 8 years before we ever bought a home. The house itself may have been one of the best financial investments of my life. It was absolutely one of the biggest investments in my family in our life. So measuring what our cost would be for that house, for that need, and a rental capacity, if you're afraid of these words, inflation, cost, interest rate, as a homeowner, I'll tell you they should terrify you as a renter. You will carry the burden of the cost for those that are taking the opportunity to buy. 100% of rent is interest.
Yep. If
right?
you're not, they always say if you're not paying your own mortgage, you're paying someone else's.
Right. But
Yeah.
I think that each and every one of you have an opportunity to do something and accomplish something very significant over these next several years, even in the market and environments that we're in. I think none of you should be fearful whatsoever. If you are, ask questions. Ignorance or fear of the unknown is always the biggest thing that I think clouds people's judgments and decisions on how to play offense instead of defense. If defense is your game, that's fine. But I don't know, Marine Corps doesn't defense, I guess. It's not in my nature. I think that compound interest and growth are the things that you should pursue, and you shouldn't be so concerned with avoiding every cost that you could possibly ever run into.
Right. Don't be afraid of making a mistake. Home prices aren't going to come down significantly until the supply goes up tremendously. That's just it's the way that it is. You won't see prices drop until there is an abundance of supply. We are nowhere near an abundance of supply. Even if mortgage rates do go up, there's still a large demand from buyers. There is a huge pool of buyers, so there's going to maintain a strong demand. Inventory remains in a very tight spot. That means that home prices, while they may slow down in a little bit in the appreciation, they may not go up as fast, which it's been an unhealthy last year or so. We've seen some really, really dramatic increases in prices for homes, and it's not sustainable to continue to do that. But the prices that they're at now, you don't want to wait to buy something because you're going to wait until prices drop, because by then mortgage rates will have gone up. And you're not going to find much out there at that time anyway, because until there's not enough demand that the supply can recover, they're only making so many houses. And, like I said, there were more houses sold in 2021 than any year since 2006. That's a huge number that shows you just how strong that demand is. As far as interest rates go, interest rates are creeping up a little bit, not enough to dramatically affect your affordability on what you can buy, but you should definitely be talking to a mortgage professional, somebody that can discuss with you what kind of an effect interest rates are going to have on your ability to purchase and how much you can afford, and not just can you qualify for, but what are you comfortable affording. So that's a great conversation to have with a professional and let them guide you through that conversation. This week, we're going to have the consumer data for inflation come up on Thursday. So we may see some movement on Thursday. Rates are very unlikely to go down from here, folks. It's one thing I want to impress upon you. There's different variables we would look for to see rates recover or go down. So don't chase rates. We're not seeing those variables. Those variables would be
talking short term. Like they're not going to
Yeah.
change so much or come down greatly in the period you're
in
going
the
to be
next
buying
couple
a
of
house.
weeks that you're buying a house, in the next couple of weeks or even a month, you're not going to see rates go from, again, this is just a made up rate for evaluation purpose, but we're not going to see a 3.75 go down to 3.25. You're just not going to see that kind of, drop in rates right now. We're in a rising rate environment, not a reducing rate environment. So don't catch yourself chasing that. Focus, on what's coming forward, what you're comfortable with, and act accordingly with that is the best advice I'd give you.
Awesome. I think it's solid advice. I think that a lot of you out here that are looking to make decisions, we want to find you where you're at, answer the questions that you have. If you have questions that you didn't ask or post in the comments section while we're on here, post them after. And we'll come back, and Hammer or myself or one of our moderators will make sure we get the information to you that you're looking for, as we always do here. VetaVA was created to be a human source of reliable information for you. We want to make visible the things that you typically do not have access to or not provided access to you. We do not want to determine for you or set up circumstances that lead you to choices that we think may be best for you, but instead we want to offer you raw visibility into the discussions, into the numbers, the data that are what you're considering, right? And impact what you're considering so that you can make an informed choice. No one can own your house for you. It's something you have to want to own for yourself. And we want to empower you to take hold of that. One house changed my life. Some of you know my story. It's only significant in saying I am a nobody, and it made a huge difference. 2 houses put everything in a completely different perspective. And I think that that story is significant because there are many people that started like I did, that didn't have a lot to begin with and needed opportunity into a thing. And so that's what we want to do here. That's what you're going to find us being present to speak to each and every week or time we come to you. If you have your questions, ask them. But until the next time, I guess, toodles.
See you later, everybody. Bye-bye.